This is my first ever consultation call I have with Trade Brigade, and this is a continuation to the video that I linked below. This is part 2 of this new series I've been making, and in this video, Trade Brigade is going to be giving me more insight into the flaws that I had with my older, more inexperienced style and strategy with the way that I trade. The reason that Trade Brigade really honed in on this is because the way he described it is my previous strategy and the way that I used to do things was more of a distraction. And on a long enough time frame, after gaining enough of a data set, when you look at all my trades and you add up and subtract my P and L, I typically would be more unprofitable and negative rather than profitable and positive. And this isn't coming from me. This is from Trade Brigade, who has over 12 years of experience of day trading and has seen all the ups and downs. Now, he really gives me critiques, so we're going to see exactly how it is that he critiqued me. And for your own sake, you're going to be able to see ways that you might be able to apply it to your own trading career. So, with that being said, guys, let's get into the video. Don't forget to like and subscribe to Day Trade Knockouts Out. And best of luck to all you fellow millionaire day traders. Fellow millionaire. I'm not a millionaire, but you guys probably are. Stay safe, so green. Peace out.
Okay. Yeah, so I think a lot of things are taking place here, but one good thing that I heard you say was like you've got a good sense for what your risk is, which is really solid. Noting that you kind of can't risk more than 40-ish cents on particular trades. And when you're trading one contract of SPY, you're not, and I hope you know this, and I'm sure you do, but like one contract in SPY, your expectations for that need to be kind of in alignment with what's real. And when you're trading in that size range, you might have a day that's like, I don't know, $250, $300, but that's a home run of a day. You caught the entire move top to bottom, executed flawlessly, when in reality, one contract usually is going to net you, like you said, somewhere between like 50 cents, $1, something like that.
Yeah,
So expectations, I think just a generic, what would I say? A general comment on expectations is like, right now you're in the learning phase of markets. You're not in the consistent income, make a living trading markets phase, which is great. Like there's a time and place for every single phase of your market journey. But just in general, keeping expectations to like kind of that zone is certainly helpful. Just because what I don't want you to do is like hold, because you'll build really bad habits this way. If you hold a contract because like you're thinking that, no, this trade's going to bounce back, I'm going to make $300, $500, $1,000 on this one contract, it's probably, it's probably not going to happen that way. So whenever those losses do start to get in the range of like 50 cents, 30 cents, 40 cents, that general area, you might start to, like, you probably want to have a max loss on one contract, basically, is what I'm saying.
Yeah.
Again, it sounds like you kind of figured that out when you were saying, my stop was a little too high on the first entry for the gap fill trade. So I liked what you were saying there, is that you've recognized kind of where you're at and what the stop size should be.
Yeah.
But beyond that, in terms of actual strategy, I can't really speak to the validity of the system below, just because I don't use things like that. So I can't say like, hey, you should enter on every third arrow when the bubble is, green or orange, or I can't really say anything about that. But what I would say is I think it might be worth, so you've got this screen on the right, the tick chart. I think it might be worth just having another time frame chart up, a higher time frame where you can see your zones, and you can also like look at candle structure, for example. Like, to me, I would want an hourly chart over there. I would go to a 30-day hourly, yep, and then I would rip out the extended hours, so no extended hours in there.
Oh, okay. Let me just
Perfect. And then I would also, like, on this chart, on this side of the screen, I would just take off all the indicators from that particular chart. And then I would also change the candles to regular regular candles.
Hold on. Like that?
Yeah. Yep. Nice. Cool. And then yeah, also just get rid of those like VWAP bands or Bollinger bands. Just because I want to just show you something. You can of course put it back after if if you'd prefer.
Like that?
Yeah, perfect.
Okay.
So like when I look at something like this now, I can kind of see generally in the morning two things took place. Number one, the opening drive was higher on the higher time frame. So if you're looking at that hourly chart, the first bar of the day on Friday, the opening drive was definitely higher for the first period. And then after that, notice in the second bar, we actually take out the low of the first hourly bar. So right there, I'm thinking, opening drive was higher. The sellers tried to make something happen, aka fill that gap. That was the trade that we were looking for, right? The fade. But the sellers were only able to do a partial gap fill, and then we closed back above the close of the first hourly bar. Right? So to me, I'm telling myself the story on the higher time frame, and you could do this with a 15-minute chart. You could do this with a 5-minute chart. You can do this with any time frame. But I'm telling myself the story of each individual candle back to back. So as soon as I see that the buyers can close above the prior bar's hourly close after a failed attempt from the sellers at the lows, right, to close the gap all the way and to get a breakdown there, I'm instantly thinking, okay, I need to find a long entry. I need to play this market long on the upside, right? The sellers are failing. It's a partial gap fill, and the buyers are strong enough to close above the prior hourly close. That's kind of like all the information I need right there to say, okay, like, buyers are clearly stronger here. My expectation is that the market will continue in the upward direction. So then from there, what I would do is like here, if you I think I can actually just grab the screen again.
You want me to stop share?
No, I think I can just take over. I think I grabbed it, right? You can see my screen now?
Yeah, I can see your screen.
Cool. I'm going to show you this grid that I have. I call it the Trinity. And it's because it's got 3 charts, and they each do a very specific thing. Let me just go to like the SPX, for example. It'll be clean. Okay. So this is my home base. This is my Trinity. This is where everything begins, right? So on the daily chart, very similar to, I'm sure, how you implement some of Carmine's stuff, right? I'm looking for my levels on the daily chart. I'm figuring out where that supply and demand is. So I would come in and like, we've got this kind of zone up here. We've got this as an interesting zone. Down here is kind of interesting. Right. So I'd come in and map out my daily levels. I'd then go to the hourly chart and refine them a little bit. Right. So on the hourly, we can see, like, let's just pretend we were headed into Friday. Right. We know that this is actually, let's grab a bar. We know that this is actually the zone right here. And I don't know. Have you been through like Carmine's classes, or do you just watch him on YouTube? Or
I took his whole course.
Okay.
Yeah, I took the whole course that he does for his whole thing, basically. And
Gotcha.
That's what it's called.
Okay. So I don't know how he particularly, I don't know what he says in the course, but for me, I'm always concerned with the open and close of candles, not so much the wicks, right? So like I drew this in here specifically because this is where there was a reversal out of the market, right? The open and close of that bar. The wicks just represent, like, you could think of long wicks as just tests in any particular direction. Whereas the candle body itself, that's where price action is closed and technically accepted. So I draw in this gray bar here because that's where the first kind of reaction comes from. If we go in the past, right, we've been making this move. And along the way, there would have been different ones, but they get invalidated, right? I'm sure Carmine has a similar kind of thought process, right? Like if this, for example, was the first one, it gets invalidated as we move underneath with closes. So then the next one would be like here, right? And now this one, it's kind of still valid as a support and resistance zone, but it's not so much like, it's not the primary concern for the low, the quote unquote low of the move here.
Mm-hmm.
So that one's kind of, oops, yeah, let's just get rid of that. That can like be a support and resistance area, but the low of the move that we're trying to figure out the bottom of so far is here. So that's why we chose this particular little interaction on the hourly chart. Oops. Um, so back to like how I'm using this, right? We know that this is a zone of interest. We never really, like, this to me doesn't really indicate too much of a strong push underneath. You could start to say, okay, now there's something here. And basically you're just building this thing lower and lower. At some point, as I'm sure you found out, you got to kind of stick to a zone and say, okay, there's enough wiggle room here where the market didn't really gain momentum underneath that level. So for me, as we're moving into Friday, obviously Friday's up here, but this level is still holding as the lows because even as we moved underneath on the Thursday session, we got that gap down, right? There was no momentum underneath for the sellers. We even get an inverted hammer right here, but there's no momentum in the downward direction. So I'm kind of thinking of this as, okay, it's kind of holding, it's trying to resolve this zone. If we were to have pushed away from it, then fine. Now it's going to act as like a demand or resistance, supply or resistance.
Yeah.
But we got the push through. So, okay, great. We've established kind of a base low on the hourly chart. So daily is coming into, right? We kind of know that this general zone is support. Hourly is confirming that sellers are not getting momentum in the downward direction. Friday is the gap up. So again, on the hourly chart Friday, I think this may have, what's going on with this thing? Why is it not like the SPY? There should be a deeper pullback here, but I don't know why there isn't. Weird. Sometimes I guess there's just that misalignment from SPY and the SPX, but the thinking,
I noticed that. Yeah.
the thinking is still roughly the same. So like, let's pretend we're going into Friday. We've basically established the context now through the daily chart that we're coming into a known area of support, right? The hourly chart is trying to respect this level. Like the sellers are running out of momentum. Don't get me wrong. That was a pretty solid down move, right? It was a breakdown of the overhead balance and we moved lower. But now momentum's starting to slow down. We've made a new lower low. It's reasonable to look for. Remember, for me, everything always boils back down to trend. When you've made a new lower low, the market can afford to have a counter trend move, which produces, in this case, of a downtrend, a lower high. Meaning that a rally wouldn't be unreasonable to set some sort of lower high expectation. So this move is like, okay, momentum's coming in, but Friday, the gap up day, let's talk about kind of what took place there, because this really, to me, informed much of the decision-making process on Friday. It's that story, once again, of the hourly chart looking and saying, okay, there was an attempt to fill the gap here. Let's go to the SPY, because this is like almost too far off. It's driving me nuts here. Yeah. Hang on a second. What yeah. Where is that? Oh, I see what it is. It's probably, I see what's going on here. All right, so on your chart, you probably had
the Heikenai candles.
Right, but you also probably didn't turn on start aggregations at open, and that would give us, yeah. See the now you can see now you can see the lower wick. That's because this bar starts technically at 9 o'clock, including 30 minutes of pre-market session. So whenever you're looking at an hourly chart with extended hours off, make sure in your settings you go to here and turn on start aggregations at market open.
Okay.
This one. That way the candle starts at 9:30 instead of at 9 o'clock.
Okay. Now, you said so have that on when I don't have show extended hours on.
Correct. Yep.
Okay.
Yep, because basically you don't want to include that first 30-minute pre-market session in the first hourly bar.
Okay.
It's going to throw off some of the structure. But the idea is still like, you could still think of this as the same undercut of that low. You would see it on a smaller time frame, like a 5-minute. But when I turn that setting back on, here, now you can see it. Look, it definitely looks more like the SPX. Let's look. So back over to our set. So
Yeah.
like the hourly chart now, right? This is just as good, if not better. The setup here, right, on the 5-minute chart. This is literally the screen that I'm watching as I'm about to enter a particular trade. This hourly is saying 3-bar play, right? 3-bar play is large, bodied bar, little inside bar in the upper 50% of that range. You look for a continuation, and it could be the downside as well.
Mm-hmm.
Could be something like this. So this right here is the 3-bar play, and on the 5, like this was also, a smaller time frame. You could have you saw basically that undercut of the low. That's what we were talking about on your screen when we had the hourly chart loaded up, and I said, "Oh, look, the sellers undercut the low, but they didn't make anything happen."
Mm-hmm.
That's kind of this move here that you could have seen on the 5-minute, right? And now when we get to this high, we're looking for any excuse to kind of go long, because we know that we're coming out of this area of support on the daily, out of the area of support on the hourly with momentum. The sellers have failed underneath the low to close the gap, which technically speaking, a gap represents thin structure, right? Sellers should close that. So when they don't, we take it as a big signal that, like, hey, sellers are pretty weak here. And the fact that the buyers were able to rebound and close right back up at these highs on the hourly chart here, right? 3-bar play,
Mm-hmm.
really, really promising looking. So the next step for me is like, okay, I need any excuse to get long on for me, there's three particular setups or 3 candles that I look for. You got your hammer candle, of course. You got its sister, inverted hammer, and then indecisive doji. Right? Any of these 3 candles is what I would call a setup bar. So I'll put SB here, because what they do is they define our risk right out of the gates. If we see a hammer candle, right, it technically implies that buyers stepped up off the lows, closed prices up towards the highs. So that's obviously got a bullish connotation. So I'll put a BU here.
Mm-hmm.
Opposite for the inverted hammer, right? Obviously, sellers step up at the high, close weak at the low, bearish connotation. And then this is really more neutral and has much more to do with the 3-bar plays, which is looking to play momentum in a particular direction. But
Okay.
what they're great at doing is instantly defining your risk, right? If we know there was a reversal down towards the low of this wick, if we know there are buyers hanging out like in this zone, then we can place a stop loss here, because it wouldn't make sense to hold a long-sided position if we're making a lower low underneath an area of support, right, where buyers were stepping up.
Mm-hmm.
So stop loss instantly goes underneath the low of that bar. Your entry is over the high of that bar, and then you're looking for, some kind of reasonable target on the daily, hourly, some kind of structure that you can look to target. So in this particular case, right, I'm just going to clear up all of these drawings. If we go back to the hourly chart and consult what's going on here, right, we know that this, I guess we could use a level, but we could also do a box. We know that this represents kind of the top of this range right here. This area basically that we're running into represents the top of the range. So if we break that, what's the next target? I mean, we've got to retrace through this thin bar and go back to here, right? So that could be a target. This is where the hourly chart and the hourly zones come into play. So breaking resistance on momentum, looking for a long, we're looking for an entry candle. So again, as soon as we see consolidation starting to form up here at the highs, looking for longs, looking for this type of candle or a combination of a green bodied bar and an inside doji like this, kind of almost like what we have here on the hourly, but over on the 5-minute chart.
Okay. Now, just your question.